Hi, this is Jack from Alpha Charts with a state of the market video. Today is September 19th, 2020. Before we get started, this video is for educational purposes only. These are not recommendations to buy, sell, or hold any stock or security, and I may hold positions in some of the equities mentioned. Know your time frame and risk tolerance. Also, if you enjoy these videos, please like and subscribe to my YouTube channel. And of course, I am on Twitter at AlphaCharts365, where I post things pretty much daily of my thoughts and ideas of the market. Also, just so y'all know, later today, I will be doing a video, kind of a play on my stocks to watch video, but it's going to be more for relative strength. So what is holding up well in this market? So look for that video, which should be out a little bit later today once I do all my research. But let's start with the state of the market. All right, so we're going to start right here with the SPX. And so we had this beautiful big run, got to a point, right? And now we've been pulling back. As you can see, this has been an important level right where we are at right now. And so the question is, does this level hold, which is exactly where the 65-day EMA is, or are we going to break down and move lower? As you can see, some good size volume came in on Friday, but it was, don't take this, too harshly, because it was quad witching and all kinds of options expiration and everything else was going on. So volume will be higher no matter what. So yes, it was a down day by 1.12%, but the volume bar is a little skewed to the high side. So that's S&P, but the Qs I think are the more interesting chart. All right, so here are the NASDAQ ETF. And as you can see, this was the original breakout, the retest, and then the continuation higher. And we got to this point, and you had this ugly looking candle right here. And now we came back. So here is my thoughts on this. I think that we had the initial pullback, the sideways movement, and I think that there is a measured move to be had here, which is 11% on this pullback, right? Kind of move sideways, and then looking at 11% coming down here, it coincides perfectly with the fib retracement for the 0.618, right? The 0.618 level right here. So this is a logical place in my mind for maybe some buyers to step in. It's got a confluence of potential. Now it may not hold, right? We may come down, we may retest the 50% retracement from this entire move. That would also be a logical level. So, but this area right here would make sense to me. And even if we undercut this just a little bit and then move, that'd be fine too. So when we look at what's left of this move, if this is true, right, we're about 6% left to the 250 mark. So 6%, which means we've already come down 12% off the highs. So we're 2/3 of the way potentially into this move. Something just to keep an eye on. Not to, if we have another really ugly looking day, there's a 2, 3, 4% down day. I don't know, don't be careful not panic selling. Know your time frame and risk tolerance, right? Know that this is an area of potential support at the 250-ish level. And so if you are, a growth stock person, then that may be an area that you may want to, just watch to see how price reacts when it does reach, if it reaches that area. Again, this ABC pattern, it makes a lot of sense to me. Remember, the primary trend, we are in a bull market, is up. So this is just a correction within a bull market. No big deal, right? It happens all the time. Nothing to freak out about it. And let's be honest, the freak out, if you're going to freak out, should end up here. If you're waiting to down here to freak out, it's a little bit too late at this point, most likely. Now, if we get below 234, that's a different story, right? This is a much bigger deal, but we're not even close to that yet. All right, that's the Qs. Again, this was the interesting chart. Again, you saw a lot of volatility come in here. Maybe we're starting to see some more come in here. We'll see what Monday brings. If we see another big spike on Monday, then, I know there was index rebalancing and there was quad witching and stuff like that. So, but it is something I'm watching, this type of volatility, one more move down, high volatility, and then maybe we could start to, base out and move back up again. Looking at the IWM, and IWM is interesting because price has not gotten really, it's right at the 9-day, 23-day EMA convergence right here, and hasn't even touched on this pullback yet on the 65-day, right? Touched here, but on, where price is today, it's not near that 65-day, where on the Qs, you'll see prices sitting right on there. And SPX, it touched it and it did bounce up a little bit. So IWM is actually holding up better than the rest of the market. Small caps, something to take notice of, right? All right, let's move on to XLF, right? So let's look at some of the important sectors. XLF, more similar to the IWM because it does weight heavily in IWM, and it's above the 65-day EMA and it's rising. So I think that XLF is holding up well. And you know that I like this chart, and I think that this chart is saying a lot right now. Get rid of this volume. Boom. And as you can see, this ratio, again, XLF versus SPX. And this is just to see if one is outperforming the other, right? Is our financials outperforming the broader market or the S&P? And I would say answer is yes. I mean, we are now starting to make this bottom. You're seeing the moving average on the short-term moving average cross up, and the 65-day is starting to flatten out with price right at it, maybe slightly above it. Again, it's a ratio chart, so it's just telling us outperformance. It doesn't really tell us much else than that. We'd have to dig into XLF and look at specific stocks to see which ones, if any, we'd want to be a part of. And I'm not even saying that XLF is ready to be invested in yet. I do own two. I think I own two equities in that in XLF, but I'm not willing to add any more risk on because I'm not seeing as a, on an absolute basis, which matters, this isn't ready yet for me to, for it to go to move higher. But I think it could be starting to make that turn. We'll see. So let's move on to SMH. So semiconductors, holding up reasonably well. As you can see, it has that A, B, and maybe starting the C pattern also. And if we look at the measured move to here, about the same as the Qs, 11 and change, right? And let's go here just for fun. And if you look at it, it's right to roughly here. So yeah, I mean, it brings it right back to retesting the breakout. So yes, there could be some more pain in SMH possibly in the future. Retest the original breakout, right, which was here, prior top here, right? What was resistance should become support. So semiconductors, if it comes out to this 153, 154 level, that may be the area that you may want to consider to manage risk against. I mean, it'd be very easy, right? If it comes down to 154-ish, if we get under 150, there's no reason to be involved. That's as easy as it gets. Also, you may see some more pain, especially in the technology sector of the market, if this SMH continues to roll over, which is how I am using it in this context, right? So I look at XLF and SMH as indicators as well as potential tradable sources. All right, so more indicators type stuff. I don't trade wood or lumber, but let's be honest, if the market was rolling over, I think we would see lumber rolling over. We don't see lumber rolling over. So that tells me that there's still strength in the market. This is resistance, trying to break out. Everything's an uptrend. Lumber looks good, so there's a good chance that the market is going to be fine. SPX TLT. looking at this one, it's rolling over, but it still made a higher high, and potentially we could put in a higher low, right? So nothing really to see here. What's interesting though, when you look at TLT by itself, it looks like bonds want lower. Looks more like a double topish type scenario. And so bonds want lower, interest rates would be going higher. We'll see if that plays out, but that's just kind of something interesting. And when you look at the TNX, which is the 10-year rate, I mean, this looks like a bottoming pattern, and it looks like it wants to move higher. That could play into banks doing better and financials in general doing better. So that kind of dovetails into that a little bit, but also has broader implications, which probably are above my pay grade. High yield bonds, um, higher highs, that's fine. Nothing to see there. But the more interesting thing is the ratio of government to high yield bonds. And when we zoom in here, we see that the markets are tame. They're fine. You're not seeing a widening of this credit spread. And because we don't see a widening of the credit spread, it tells me that there's nothing wrong with the market right now, that this is just a run-of-the-mill type of pullback. Now, if I see these start to really move up, that would get me a lot more cautious. And we're just not seeing that. So again, I think this says stay calm. There's nothing really to freak out about. I mean, look at the VIX. When you look at the VIX, again, it's elevated still at 26.7. But again, nothing to freak out about. I'm sorry, 25.8. It's at 25.8. But again, nothing to freak out about. We're not seeing these big spikes in VIX or anything like that. So yeah, I mean, it's just one more piece of the puzzle. But again, it's telling us don't worry yet, at least. Let's look at put call ratio. Put call ratio. We had been in very very bullish type scenario right here. And the market has a way of shaking that out, right? So I think that we probably will continue this shakeout. I wouldn't be surprised if we get into this area. We don't have to hit 1.4 for this to turn back up, but we could. I mean, if we did, that would be, a perfect time to consider risk. But as of right now, put call ratio is saying that there could be some more shakeout to come, but it's already started, right? We're already kind of getting there. Again, nothing that says, again, I guess the shakeout has already begun. That's probably the most important thing. Let's look at gold for a second. So looking at gold, this is really interesting. These were the prior highs back in 2011. And then we made this huge base, right? Ran up, and now it's making this nice, beautiful flag. Wouldn't be surprised if we see another leg up in gold here. I mean, the flag is right at that prior band of resistance, and now it should act as support. And this could be a really, really interesting area. I mean, could we make some kind of inverse head and shoulders here and kind of come back around? It's possible. It doesn't even have to be this deep. It could be just kind of like a sideways movement right here and then a rotation up. That wouldn't be shocking either. But gold is interesting. And when you look at gold versus the SPX, so is gold working or is S&P working? It's making, again, this is the 2011 highs in this ratio chart. And look at this base that the gold versus S&P is making, right? If this can come back around and break out here, I mean, gold is by far going to be outperforming the S&P. And it just makes me think what kind of environment that would create. But this is definitely a chart I am watching and watching for this breakout. Again, I think it has some more work to do. And it could be that they are both going up, right? Gold just going up faster. It could be gold going up and S&P going down, right? That's outperformance. And it could also be that they are both going down, but S&P is going down faster than gold. So all three scenarios are possible, but this basing pattern is something that's very, very interesting to me. All right, so another sentiment is the CNN fear and greed right over here. We're at neutral. again, I think that we have some more room to the downside here before we start to move back up, which kind of plays into the scenario that I'm saying that there's one more, maybe 5, 6, maybe even a sharp decline this week. I think this week will be a volatile week, and I think that there's more downside coming, and this says that we have room to the downside. Put call ratio says we have room to the downside. The NASDAQ says we have room to the downside. So that's what I'm guessing. But I think it's going to be probably sharp over the week, but I'm not too worried about it at this point. So we were looking at, let's look at the value line geometric index value. And you see value line geometric index, the breadth of the market is actually holding up pretty good. And that one brings me to the next thing. So when we look at the Qs, let's bring it back full circle, looking at the Qs, and what the heck, I'll just bring it to keep it on the line chart, right? You'll see here's my ABC pattern down, here's my target, and that's where price is sitting right on the 65-day EMA. So when we look at what makes up the NASDAQ, there's really 3 companies that are 1/3 of the NASDAQ, which is Apple, Microsoft, and Amazon. So let's see if those companies, how they're faring versus the rest of the market. So let's go ahead and look at Apple first. And you see Apple is just broke down slightly below the 65-day EMA, and maybe has a date with this 99, 100-ish area after the split, right? All right, so Apple, we'll call it about the same as the market. Amazon. So as you can see, Amazon is well below the 65-day EMA, which is now actually starting to turn down, and all of these moving averages are moving down too. So Amazon is faring much worse than the market as a whole. And looking at Microsoft, also very similar to Amazon. Look, these moving averages are all about to cross down, but again, this 187 to 190-ish range, I think that is the area that we should be looking for as far as Microsoft goes. So the point being is that if 1/3 are faring, Apple's doing about par with the market, and Microsoft and Amazon much worse than the market, in my opinion. And if you look, let's even look at Facebook just for fun, which is a much smaller percentage, but again, doing worse than the market at this point. So if these biggest companies, which is roughly, that's 40% of the market right there, of the QQQ market, I should say, if they're doing worse than the market, they're going to be pulling it down. Once we see those 3 to 4 stocks start to stabilize, I think you'll see the market also start to stabilize. So just to recap what I'm thinking, I think this is an ABC down pattern. I think this 250-ish level, which is about another 6% to the downside, which could be very sharp this week. We could have a couple of really ugly days. I think there's another leg lower coming, or maybe we've already started it right here, which is very possible. I think that this is a shakeout within a longer term context. I don't see any stresses in the market. Lumber is looking good. Credit spreads are looking good. Put call ratio is nothing crazy going on there at this point. So I think, stay calm. So that's what I have for you today in my state of the market. Again, I'm going to start doing my research for relative strength, because I think that there'll be buying opportunities coming really, really soon. And even though the market looks pretty crappy, there's a lot of stocks that are holding up really, really, really well. And I'm going to go ahead and I'll do a watch list, stocks to watch that video in a little bit, and I will share those with you. Hope you all have a great day. Stay safe this week in the markets, and happy holidays, and take care.